One, it's me yet again, and I hope you guys are doing okay. So yeah, I hope you guys did well on the test, and yeah. So if you have any question about anything, just let me know. Regarding the test, regarding the questions. Um, all right. So today we're gonna start chapter 9. Which focus on business income deduction and accounting methods. So in previous chapters, since the beginning of the class until now, we have been heavily focusing on discussing about how to determine income, how to determine deductions for individual taxpayers. Right? So starting from chapter 9, we gonna start to talk about a little bit about the business side, like the how to calculate, how to compute the income for business, right? So starting from these chapters is going to be a little bit different, and I hope this part of the class is going to help you guys to make a good transition from individual tax to corporate tax. So I know in this class our focus is heavily on individual taxation, but and then this the rest of this class we're going to talk about the business, the income for business, but mostly it's going to be focusing on the business that are owned by an individual taxpayer. But still, there's a lot of things in the material that we will discuss from now until the rest of the semesters. It's going to help you guys. It's going to be similar to the items in corporate tax. So I hope this part of the class is going to help you guys to make a smoother transition from individual tax to corporate tax. And I assume you guys going to follow. You guys going to have to take a corporate tax class sometime in the future. So I hope this part of the class is going to help you a little bit, in that class. All right. So yeah, I forgot what I wanted to say. One more thing. Anyway, so yeah, so let's start. So as the name of the semester, that's the name of the chapter suggests, right? So in this chapter, we can mainly focusing on discussing three matters, right? Business income, deductions, and accounting methods, right? So let me close it up. For business income, and like I said, in this chapter, we're going to mainly focusing on talking about the sole proprietor business, so meaning a business that is singly owned by someone, but again, a lot of the material that we're going to cover is going to be applicable to other types of business, right? So all right, so for sole proprietorship business, when you, or basically flow through business, right, or S corp, right? As we have discussed about this a little bit, we not exactly discussed, but we kind of mentioned about it a little bit before, so for flow through entities, right, the business income and expenses can flow through the taxpayers' tax returns, right? So the taxpayers, the owners of the business, don't have to file a separate tax return for the corporation, for the business, right? So whatever they make in the business and whatever expenses that they incur while conducting the business, they can directly incorporate those items into their individual tax return, right? So for flow through entities, which is going to be the focus of our chapters, the taxpayers need to file the business income and the business expenses in Schedule C, which is like just an attachment to the individual tax return form, right? So basically, this Schedule C is not a separate tax return, right? It's just an attachment, a form that attached to the individual taxpayer's tax return, and whatever income, whatever expenses that are reported from here, taxpayer can calculate using this Schedule C, and then use that number to incorporate in their tax return form, right? So this is for flow-through entities, right? But for other kind of corporation, for C corporations, taxpayers, the owners of the business, need to file a separate tax return for that business, for the business. So so that's a little bit different there, right? But again, our chapter is going to be mainly focused on the flow-through entities, All right, all right, so for similar to individual taxpayers, gross income, the gross income of business, gross business income, basically have to include every channels, every items of revenues that the business have generated, except for the exclusion and defer items, right? So basically, the definition for gross business income is basically similar to the definition of individual income, right? So basically, it's going to include everything, every sources of income that the business generates, except for excluded and deferred income, right? So the definition of business income is pretty straightforward and similar to the definition of income for individuals, right? For deductions, though, so deduction is going to be the part where we're going to have a lot of controversial discussion, between the taxpayers and the IRS, right? Because this is where there's a lot of gray areas where the taxpayers going to argue, going to have a different opinion with the IRS, right? But basically, the IRS and the Congress, they only allowed the expenses that are directly connected to the business activities to be deductible, right? But as we know, when you own a business, sometimes it's very easy to get commingle between personal expense and business expense, right? So that's why the IRS they are really trying to scrutinize this part of the business expense, right? So, but in general, so deduction for business expense, it has to be directly connected to the business, right? It cannot have some personal activities related to it. Okay, so there are conceptually there are two requirements for the deduction of business expense, right? It has to be ordinary and necessary, and it also has to be reasonable. So ordinary and necessary basically means that it has to be related to the business expense, right? And it has to be needed. It has to be generated. The expense has to incur to support the income generating activities of the business, right? So in other words, the expense has to be important enough so that without the business expense, the business might be, the operation of the business, of the income generating activities of this business might be impacted greatly, right? So, and then reasonable meaning it cannot be extravagant. It has to be reasonable in amount, right? So, for example, if let's say if a business buying some company cars, and then the car just for the use of the employees. So basically, employee can check out the cars and drive for business purpose. So in a similar business, maybe other business just gonna buy, say, some ordinary cars, say Toyota Camry or I don't know, just some ordinary car, But then this business, they instead of buying such ordinary car, they decide to buy, say, a Rolls Royce. Right? So definitely, a Rolls Royce can be much more extravagant than a Toyota Camry, right? So so if that business deal wanted to deduct the expense of buying a Rolls Royce, then definitely that is not reasonable, right? Or for example, if let's say, if for example a business meal, right? You take our potential clients to a business lunch. So initially, normally the business lunch should cost maybe less than $1,000, let's say, but somehow that day you decided to take the client to a very high-end restaurant, a Michelin 3-star restaurant in New York City, and then the bill came back to be maybe, say, $5,000 to $10,000 for that meal, So definitely, the IRS not going to be happy with that expense that you wanted to deduct, right? Because usually it's only cost you $1,000 to treat the potential client, but this time it costs you $10,000, right? So it's not normal, it's not reasonable at all, right? So that's just some examples about the characteristic of the expenses, right? So again, the expenses, the deductible expenses has to be ordinary and necessary, and at the same time has to be reasonable in amount. All right. So, and here are some of the typical ordinary and necessary business expenses. So advertising, car and truck expenses, depreciation, employee compensation, insurance, interest. In the case the business gonna acquire some loans and they have to have interest expense, right? Legal fees, office expense, rent, repair, supply, so on and so forth. And then one thing I want to point out is that the business expense don't have to be repetitive, to be able to consider as ordinary necessary, because sometimes there are some occasional expenses that are necessary for the business to run. It has to be incurred for the business to run, but it's not repeated. It's like a 1 or 2 times things, or it only happens once in, say, 2 or 3 years, right? For example, legal fees, right? Legal fees. As a business, you're not going to face a lawsuit so many often, right? Maybe once every 3 years, someone can sue you, and then you have to incur some legal fees, right? Court fee and a fee to pay the lawyers, right? So even though the legal fees are not repetitive, but still it is necessary for you to incur those expenses, right? Because without that, like, you may lose the lawsuit and then you may go out of business, right? So again, those are kind of expenses that are necessary and ordinary, but they are not repetitive, So again, these are kind of like an area where business owners, taxpayers have to be very careful, in terms of record keeping, in terms of explaining to the IRS, and so basically the taxpayers, the business owners, have to make sure that they keep enough proof so that in the case where the IRS come back and they ask for for explanation about some certain expenses, the business owners, the taxpayers, should have enough evidence to prove that, okay, the expense that I'm deducting here, it is ordinary and necessary, and it is reasonable in amount. So yeah, but still, again, sometimes it's kind of difficult, right? But yeah, but this area is an area where the IRS really pay a lot of attention to, and they really try to scrutinize significantly in this kind of scenarios, in this kind of items. So taxpayers and business owners have to be careful, have to have enough proof to support their deductions. All right. So let's look at this example. So this example is an example of reasonable amount. Right? So it says Rick owns a business that employs his brother Ben, and Ben is paid $45,000 per year by Rick's business. In comparison, other employees with Ben's responsibilities are only paid $30,000 per year. So what is Rick's business deduction for employing Ben? So this is like similar to the previous example that we just talked about, right? So in this case, Rick, right, he only pay other people with the same responsibilities $30,000, but he pay his brother $45,000, right? So the amount itself is more it is extravagant, right? It is much higher than, it's like 50% higher than a normal expense, right? Than the single expense, right? So in this case, of course, Rick cannot deduct the whole $45,000, right? In this case, he is only able to deduct the $30,000, which is considered as reasonable in amount, right? And then the rest of the amount, the $50,000, he need to treat it as like a gift to his brother, right? And he cannot use that $50,000 extra to deduct for his business, right? All right. So let's talk about some limits about the deduction, right? So as I said, the IRS, they really want to scrutinize. They really want to be careful in judging whether or not the deduction of a business expense is reasonable and is legit, right? Is valid, right? So in general, there's some limits on the kind of expense that a business can deduct, right? So first of all, expenditure against public policy, right? So what does that mean? Meaning fines, right, or penalty that the business have to pay in the order of by the order of the laws, right? And then bribery, of course, because it's illegal, right? Lobby expenditure, political contributions, right? So the first two items here, fines and bribery, of course, that's the wrong thing to do, right? The business owner have to pay fine, have to pay penalty because they already done something wrong, and bribery is illegal in the United States, right? In the U.S. So for the first two items, of course, it's against public policy, right? And then the other two items, lobby expenditure and political contributions, even though it's not illegal, but it's not how to say, you can consider it as like as not being a ordinary and necessary kind of expense. Your business can still operate if without those expenses, right? So yeah, so in general, for expenses to pay for fine, for bribery, for political contribution or lobby expenditures, those kind of expenses are not deductible, right? All right, and then the second case I want to talk about is expense related to a tax-exempt income, right? So this is kind of obvious, right? Because tax-exempt income, it is not included. The income itself is not included in the gross income, right? So the expenses that are related, the expenses that are incurred to generate this kind of income, it should not also be included in the tax return, right? So it should not be deductible, right? So some of the example for expenses related to tax-exempt income is interest on loan to buy municipal bonds, or key employee insurance premiums, if the beneficiary is the business itself, So some company, they buy life insurance for the employee, but they make themselves as a beneficiary of the policy, right? So if the employee, something happens to the employee, and the employee cannot work, or the employee pass away somehow, then the one who received the premium, the payout from the insurance is going to be the business, right? So in that case, the company cannot deduct the expense that they incur to pay for the premium of this kind of insurance plans, right? All right. So let's look at this example, right? So this example, it says Emma borrowed $90,500 from Frost Bank using her business assets as collateral. She used the money to buy City of San Antonio bonds. Over the course of the year, Emma paid interest of $7,300 on the borrowing funds, but actually she received $6,300 of interest in bonds. Right? How much of the interest expense can Emma deduct? So obviously, this is the expense that Emma is paying is to pay off the loan on which she used to buy the bond of the City of San Antonio, which is the municipal bond, right? So it's a tax exempt bond, right? So because of that, Emma cannot deduct any of the interest that she had to pay here, right? So it's zero, right? Whatever she had to, whatever amount that she can deduct, it's going to be $0. Right. All right. So the next item I want to talk about is capital expenditures, right? So probably we all familiar with the concept of capitalized and expense, right? So basically, capitalized means you have to consider the whatever that you're acquiring as a part of assets, and then you're going to depreciate or amortize the asset over time, right? Instead of expensing, mean you can just deduct the whole amount, right? So for example, if say if the business decide to buy a car, so hypothetical scenario, if the business can expense the car, then they can expense the whole amount that they used to pay for the car, right? But for capitalized, they have to consider the cost of the car as a part of the asset now, and then over time they can just depreciate the car, depreciate the value of the car, right? So obviously, if the business can have the option to expense the whole value, or the whole cost of the car, the whole amount that they used to pay for the cost of the car, then that's going to bring down the business income for that year quite a lot, right? Instead of capitalize, taking the cost as a asset and then depreciate over time, right? So the depreciate expense is going to be much smaller than the amount when the taxpayers, the business owner, can expense the whole cost of the car, right? So obviously, as a business owners, you probably want to expense the total cost, right? But again, whether or not you can do that is depending on the characteristic of the expenditures, right? So generally, there's a 12-month rule, right, that the IRS want you to follow. So what does this rule tell us, right? So basically, taxpayers can only expense the cost, right? Can only deduct the expense if the benefits that this cost brings to the taxpayers is shorter or equal to 12 months, right? And then the benefits does not extend to do not extend beyond the end of the next tax year, right? And then this rule does not apply to insurance expense, right? So let's look at the example. Maybe it's gonna be a bit clearer. So let's see. So Ben, a cash basis taxpayers, makes the following payments on June 30th of this year. So he make $10,000 for the next 10 months of utilities. So this is like a kind of like a prepaid type of thing, So he paid $10,000 for the whole month, for the next 10 months. He paid $12,000 for insurance over the next 24 months, and he paid $9,600 for the next 8 months of interest on business loan. Right. So just by eyeballing the item that Ben is paying, we know that the 12 months rule only apply to the first two items, right? Because we know the 12 months rule does not apply to the interest expense, right? So it's only applied to the first two items here, right? So for the first items, Ben paid $10,000 for the next 10 months of utilities, right? So first, the benefits is smaller than 12 months, right? And then second, the benefits does not go beyond the end of the next tax year, right? So because Ben is a cash basis taxpayer, so he's going to use the calendar year, right? And so his tax year is going to end on December 31st of each year, right? So, and in this case, he paid for this expenses on June 30th, and then the first item, the expense only lasts for, the benefit only lasts for 10 months. So that means this benefit does not go beyond the end of the next tax year, right? So that means the first item Ben can deduct the whole amount, right? The whole $10,000 amount, right? All right. What about the second items? Right. He paid $12,000 for the insurance over the next 24 months. Right. So obviously, right, the benefits here exceeds the 12 months period, right? And also it also exceeds it also go beyond the end of the next tax year, right? For this 24 months, of course, it's going to go beyond the end of the next tax year, right? So we know that because of that, we know that the second item failed the 12-month test, right? So Ben have to capitalize this insurance, right? All right. So let's look at the solution. All right. So like we said, Ben can deduct all $10,000 for the utilities, right? Because it satisfies the 12-month rule, right? For the insurance, on the other hand, he have to capitalize this insurance, right? So he can only deduct $3,000 of the insurance, right? Because $3,000 is how much of the expense that bring about the benefit until the end of this tax year. So he paid for this insurance plan on June 30th. That means there are 6 months left to go, right, for this tax year. So for this case, we calculate the monthly expense for the insurance rate. So he paid $12,000 for the 24 months. So that means the monthly expense going to be $500. And since the benefits for this year is only 6 months, so we take $500 times 6, and that gives us $3,000. Right? That's why we have $3,000 here, right? Because we have to calculate the monthly expense for them. for the insurance, and then just times it with the period that the period for this tax year, right, which is 6 months. Right. All right. What about the interest on the business loan? Right? So we know the 12 months. The 12 months rule does not apply to the interest expense, right? So it doesn't matter. It doesn't matter how long the benefits gonna last, right? So in this case, we just takes so on the next 8 months, right? So we just calculate the monthly expense as well, right? And then we times with whatever the period that available for this current year, right? So $9,600 for 8 months, so 96 divided by 8, and then we times that with 6, right? Because that's how long we have for this year, right? Because the taxpayer, he paid for this on June 30th, right? So we have 6 months for this tax year, right? So that's why we get to the amount of $7,200, right? Right. All right. So yeah. So let's move on with our lecture, right? So another type of limitations that I want to talk about is the cases where the business expenses can get mixed up with the personal benefits, you know. So like I said, as a flow through business, right, S corp kind of business, it's very easy to commingle between business purpose and personal purpose, you know. So that's why it's very easy it's very easy for the taxpayers to deduct the expenses that are associated with the personal benefits, right? So that's why this is an area where the IRS really pay close attention to, right? Because this is probably one of the most the greatest area, I would say, right? Because it's very easy to get mixed up between personal and business activities, right? So again, the business expense deduction can only be deductible for purely business purpose expenditures, right? So for personal expenditures or for purely personal expenditures, yeah, those kind of expenses are not deductible, right? So however, there's some exception, right? So for example, let's say you have to buy a uniform or some kind of special clothing for you to perform a job, you know. So even though it's clothing is something personal, but it is required to perform a job to provide, yeah, that's right. So because of that, you can still deduct the cost of acquiring those kind of clothing, right? However, if the clothing are required, but if they can substitute for your day-to-day kind of clothing, you know, if that's the case, then you cannot deductible, right? So the uniforms, the clothing, it has to be designated to only for professional use, right? For for the use on the job, right? You cannot just wear that to walk on the street, to go shopping, for example, right? So all right, so if the clothing, if the uniform is only be used for professional purpose only, then you can deduct the expenses to acquire those kind of clothing, right? What about education, right? Education expenditures. So some taxpayers can argue that while I go back to school, I go to some training sessions, you know, to equip myself with a better skill set, better knowledge to make sure that myself maintain or improve the professional knowledge, to be able to perform the jobs. Well, yes, right. If that is really the case, if you are really go to a session, go to trainings, and then you pay for yourself to attend those kind of training session, yeah, I think to me, you can consider that as business purpose kind of activities, but according to the IRS, to them, because they have a relatively more stricter way of viewing things, so for them they only consider those kind of expenses deductible if the taxpayers are self-employed person, right? So let's say if you are employed, say like myself, I'm an instructor employed by the university, but let's say I pay for myself to a teaching seminar somewhere to improve my teaching skills, and I wanted to deduct that, right? Deduct the expense that I pay for my training sessions. Well, the IRS gonna say no, because I'm employed by someone else, right? I'm an employee, right? But for example, if I'm a self-employed person, I have my own, let's say I have my own accounting school and teach people about accounting, and then that's my only job. I am self-employed. I only make money from that my own accounting school, and then I pay for my trip to a teaching seminar, to improve my skills. If that's the case, then I can deduct the expenses I pay for myself to go to that training session, right? So yeah, so I just want to make sure that you guys remember that only education expenditure is only deductible if the taxpayers is self-employed. All right. What about mixed motive kind of expenditures? So this happens a lot, right? So let's say taxpayers go on a business trip, and then spend maybe 2 to 3 days working on trying to meet up with some client, try to acquire some new clients, potential clients, and maybe another 2 or 3 days to relax, spend some vacation time at that location, So for those kind of trips, right, the expenditure for those kind of trips, definitely they got mixed up, right, because the taxpayers have both business activities and personal activities during the trip, right? So what do we do, right? So depending on the type of expenditure, depending on the characteristic of the expenditures, then we have a different way to treat the expenditures, right? So first, let's talk about entertainment and meals, right? So for entertainment and meals, first let's talk about entertainment, right? So for entertainment expenditures, the taxpayers can deduct those kind of expenditures if the entertainment activities can be treated as a compensation for the employees, right? So for example, if taxpayers as a business have let's say a restaurant, and then as a bonus to his or her employees, at the end of the year, he paid for all his staff, for a trip to Disneyland, let's say, right? As a bonus, if they perform well during the year, so he give them a bonus trip to Disneyland, so in that scenario, the entertainment expenditure, right, the trip to Disneyland can be treated as a compensation to the employees, right? And the taxpayers in that case can deduct the expense for the trip, right? But that's the only case. That's the only time where entertainment expense is deductible, right? If the entertainment expense is to entertain a potential client or current client, then it is not deductible, right? What about meals, right? So for meals, because well, according to the IRS, the way they view things, for meals, you, whether or not you are doing business activities, you have to eat anyway, right? So that's why the IRS only allow 50% of the business meals that deductible rate. It doesn't matter. If the whole meals, the tax rate just talk about business activities with the clients or not. If the taxpayers, as long as the meals is related to business activities, the tax rate can only deduct 50%. Right? However, if the meals is purely for personal purpose, right, then it is not deductible. Right? So, for example, like the example I gave, right? So a taxpayer go on a business trip, and for the first 3 days, let's say he trying to acquire some new clients, and then for the remaining 2 days of the trip, he just relax, spend some time relaxing, vacation, right? So the meals for the first 3 days, he can deduct 50% for the meals, right? But the meals for the last 2 days, where he only enjoying himself, he cannot deduct, right? So that's pretty much it's pretty reasonable, right? However, even for the business meals, right, there are some requirements that the taxpayers have to meet to be able to deduct that 50%, right? So there are a few requirements. So the meals need to be ordinary and necessary, right? Meaning, well, the tax, let's say the potential client or the current client only want to meet during lunch or dinner, and there's no way to do it otherwise, then it can be treated as ordinary and necessary activities, right? And then the meals has to be reasonable in amount, right? So, like I said, if for you, usually you spend less than $1,000 to treat the clients, but all of a sudden this time you spend like $5,000 to $10,000, then maybe it can be considered not reasonable, right? But still, it's kind of like a gray area. It depends on what kind of client it is, So that's why the taxpayer have to make sure that they prepare some proof, to back up the ordinary, necessary, and a reasonable requirement for the business expense. Right. So, and then the other requirement is that the taxpayers have to attend the meal, right? Have to be present at the meal, right? So they cannot just say, let's say the taxpayers offer to pay for vacation of the client, right, where he doesn't attend the vacation, right? So if that's the case, then the expense is not deductible, right? The taxpayer have to present. The taxpayer has to present at the meal, right? And then the people who attend the meal has to be with the current or potential clients. And then the final requirement is that the meal, it has to be purchased separately from other entertainment activities, right? So let's say the taxpayers meet up with the client at the restaurant, and then later on they decide to go to watch a ball game together, So the taxpayers in that case have to separate the bill for the meal and the bill for the entertaining, the ticket to go to the ball game, right? The baseball game, right? And then of course the entertainment part, right? The ticket to the ball game is not deductible, but the meal with the clients before the ball game, the taxpayer can deduct 50% of that meal, right? All right. What about travel and transportation? Right? So transportation expense can be deductible, if the transportation expense is necessary for the taxpayers, meaning it has to happen to take the taxpayers to and from a business location, to conduct the business, right? So if that's the case, then the transportation expense is deductible, right? However, if the transportation expense is to pay for the taxpayers commuting from home to a regular office, regular business site, then if that's the case, then it is not deductible, right? It has to be the business site, the business trip. It has to be not regular, right? So if the taxpayer just drive from home to the office and drive back every day, then the taxpayer cannot deduct that cost, But let's say once a while the taxpayer have to fly to a different city to meet up with the potential clients, then that transportation expense is deductible fully, And let's say if the taxpayer does not fly, does not take train, but instead driving to the location, to the business site, then the taxpayers can choose to deduct by the mileage, right? And currently the allowable deductions rate is 58 cents for a mile that the taxpayers travel to and from the business site. Right. All right. And again, right, only transportation expenses that are related to that are primarily business, right, can be deductible, right? And we're going to talk about what is primarily business in a little bit, right? So basically, well, I can just tell you now. So basically, if the majority of the time of the trip is to conduct business, then the taxpayer can consider that as a primary business trip, right? And he or she can deduct 100% the cost of transportation. So let's say, let's go back to our example earlier, right? So if a taxpayers go on a trip and spend 3 days to meet up with potential clients, and then spend 2 days relaxing, right, enjoying some vacation time, then for him, he spends 3 out of 5 days as to conduct business, right? So to the IRS, that trip that the taxpayer is taking can be considered as a primarily business, right? Because he spends 3 out of 5 days, pretty much 60% of the times he's doing business, right? So if that's the case, then that can be considered as a primary business trip, and the transportation to and from that location can be deductible, right? But let's say if the taxpayer spend 2 days meeting with the clients and then 3 days vacationing, then the transportation expense cannot be deductible, because now that trip can be considered as a primarily personal trip, right? So yeah, but we're gonna talk about that example in a little bit, right? What about other travel expenses, right? Say lodging or other kind of incidental expenditure, say toll fees, something like that. What about those, right? So those travel fees are only deductible if the taxpayer is away from home overnight, right? So if it is a one-day trip, then the other travel expenses are not deductible, right? The taxpayer have to be at the business site overnight, right, to be able to deduct the lodging expenses, right? Right. And then, like I said, for mixed purpose trip, the taxpayer can only deduct the portion of the trip, of the travel expense that are related to the business activities, right? For the portion of the trip that are purely for personal purpose, the taxpayers cannot deduct any expenses during those times, right? And then again, right, like I said, the taxpayer have to document the business purpose, have to document the proof that I'm going there to conduct business not to do my own personal purpose kind of activities, right? So again, taxpayers have to make sure that they have some proof to prove that the traveling is for business purpose, not for personal purpose, right? All right. So let's look at this example, right? So it's a Ben paid the following to attend a business meeting in Chicago. So airfare $1,200, hotel 3 nights for $750, and meals for 3 days $270, right? So there are two scenarios, right? The first scenario is that Ben spent 2 days in the meeting and 1 day just sightseeing, right? So if that's the case, then the trip can be considered as a primary business trip, right? And then the second scenario is Ben spent 1 day in the meeting and then 2 days enjoying himself in the city, so that trip is going to be a primarily personal trip, right? So let's see, right? So for the first scenario, for the primarily business trip, right, because this is a primary business trip, he can deduct the 100% of the transportation expense, right? So he can deduct the whole amount of the $1,200 of airfare, right? And then for hotel, it's going to be just for the days that the taxpayers pay for staying for the business purpose, right? So in the first case, for the primary business scenario, the taxpayers spend 2 days attending the business meeting and then 1 day doing personal activities, right? So that's why the rate is $250 per day, so he can deduct $500 for the days that he attends the business meeting, right? And for meal is 50%, right? So in total, he incurred $270 for 3 days. So we can just, on average, we take the average amount for 1 day, which is $90 per day, times 50%, right? So for the first scenario, because he spent 2 days in the meeting, right? So he can deduct the expenses for the 2 days, right? So it's going to be $90 per day times 50% times 2. That's why we have $90 here, right? So that's going to be the total travel expenditure that he can deduct, right? What about the other scenario, right? For the primarily personal scenario, since this is a primary personal trip, he cannot deduct any of the transportation expense, right? So the airfare he cannot deduct at all, none, right? For the hotel, because he only spent 1 day in the business meeting, so he can only deduct $250 for the day that he attended the business meeting. And then for the meals, so because he only attended 1 day, right? So we just take $90 times 50% times 1, which is $45, right? So you can see the big difference between the primarily personal trip and the primary business trip, right? So and the taxpayer have to make sure that he or she has the proof to prove that, well, I'm spending this much time attending business activities, right? Not for my own personal, right? So all right. So yeah, so let's move on, right? So the last item that I want to talk about regarding the limitation of the business expenditures, is about the business interest. So there's a rule that are set up to limit the business interest, the interest expense that the business incur, so there's a limitation. There's a rule that limits the amount of interest expense that the business can deduct, right? However, this limitation is only applied to taxpayers who have a revenue of $26 million or more, in the prior 3 taxable years, right? So taxpayer with lower net revenue than the $26 million benchmark do not need to worry about this, right? But for taxpayer with significantly big revenue stream, they have to pay attention to this limit rate. So what does this limitation rule tell us, right? So basically, the business interest expense deduction is only limited to the amount of business interest income plus 30% of the adjusted taxable income, right? So this is the limitation amount. So business interest income plus 30% of adjustable taxable income. So what is adjustable taxable income? Right. So the long definition in the textbook is that the adjustable taxable income is the taxable income allocable to the business computed without regard to any item of income, gain, deduction, or loss not properly allocable to trade or business, interest expense or income, depreciation, amortization or depletion, net operating loss deduction. So this is a long definition. The short definition of this is that it is taxable income allocable to the business computed without the interest income and before depreciation and interest expense deduction. Right. So basically, you take the taxable income, you subtract the interest income, right, and then you add back the depreciation and the interest expense deductions, the interest expense, right. So that's the short definition, and it's more easier to understand kind of definition, right. So let's look at. We're going to have two examples, right? So this is the first example, and then the second example is going to be a problem that I took out from your homework, So hopefully that's going to help you with the homework, right? So let's look at this example first, right? So we say this year, this corporation reported $300,000 of taxable income on $30 million revenue, right? So this firm is making $30 million, so of course it has to so the rule applies to this company, right? And then the revenue included $250,000 of interest income. So interest income is $250,000, right? And $300,000 of taxable income, right? So in calculating your taxable income, the company already deducted $340,000 depreciation and $210,000 of interest expense. So it's asking us what's the maximum business interest deduction this year. Right? So first thing we need to do is to calculate the limitation limit rate. So which is interest income plus 30% of adjusted taxable income rate. So let's see how do we do it, right? So first we need to calculate the adjusted taxable income rate. So we take, like I said, right, we can just follow the more simple definition, right? So we take the taxable income, we take out the interest income, and then we add back the depreciation and the interest expense, right? So we know the taxable income is $300,000, interest income is $250,000. So we take out the $250,000, and then we add back the depreciation and the interest expense, right? So we know depreciation is $340,000 and interest expense is $210,000. So we add it back here. So that gives us our adjusted taxable income of $600,000, right? And then we times the adjusted taxable income by 30%, right? And then whatever that gives us, we add back the interest income, right? So we take $210,000 here, add back $250,000, and then we have our limit, right, for $30,000. Right. So even though it look kind of long, it should not be that hard, as long as you memorize the formulas, then you should be able to do it pretty quickly, right? All right. So let's look at this second example, right? So this example, I took it out from the homework, right? So even though the problem look very wordy and very complex, it should not be, right? We just follow the formula and we should be able to do it, right? So the question says Renee operates a proprietorship selling collectibles over the web, and last year she purchased the building for $24 million for her business, right? And then this year her business reported a revenue of $85 million and a total expense of $78.1 million, right? And her expenses include the cost of goods sold of $48.5 million, sales commission paid of 6.4 million and 10.5 million of interest paid on the beginning mortgage, and 12.7 million of depreciation. Right? So the question asks, what is the maximum amount of business interest expense that Renee can deduct this year? All right. So similar to the prior example, right? First, we have to calculate the adjusted taxable income, and then from there we can calculate the limitation, right? So how do we calculate it? The adjusted taxable income, right? So let's see. Let me open an Excel file. Right, so the first item that we need in that formula, right, is taxable income, right? But in here they don't say what is the taxable income. Right? However, they give us the total revenue and the total expenses, right? So from there we can calculate the income, right? So income is equal revenue subtract expenses. So we have total revenue here, which is 85 million, and then total expense, which is 78.1 million, right? So with these two items we can calculate our taxable income, right? The total taxable income, which is going to be the sum of this two, or the net of this two. So we have 6.9 million of taxable income, right? And then what else, right? The formula tells us we have to take out the interest income of the business, right? So what is the interest income of this business? So I'll expand the cost of goods sold of this, sales commission paid this, 10.5 million of interest paid, so it's going to be interest expense, and then 12.7 million of depreciation, and that's it. So they don't mention anything about interest income, so we can just assume interest income is zero. So interest income is $0, right? So after we take out the interest income, so let's see. After we take out the interest income, we have to add back the depreciations in expense and the interest expense, right? So depreciation, in here we have 12.7 million of depreciations, 12.7, and then interest expense is 10.5 million, right? So we have interest expense 10.5 million, 10.5 million, right? So there we can calculate our adjusted taxable income. Going to be the sum of this. The sum of this three, right? So our adjusted taxable income is $30.1 million, right? Then we have to times this by 30%, right? So this equal this times 30%. So it's going to be 9.3 million, right? So let's say 30%. So 9.3 million, right? And then we have to add back the interest income, right? Interest income, which is zero here, right? So in total, our limit is going to be the sum of these two, right? So we which is $9.3 million. Right. So yeah. So see, it's pretty straightforward, right? Even though it look quite monstrous, it had a lot of information, but as long as we apply the formula, we can solve it. All right. And then let's get back to our slides here. Right. And then other than that, right, there are some other specific deductions that business owners might have to expand and may want to deduct, right? So loss on disposition of business properties or casualty, right, meaning damage or losses of business properties, right? So for the first case, the losses on disposition of business properties, meaning the taxpayers just want to sell they decide to sell the property, and then somehow they incur a loss, right? So in general, they may be able to, depending on the scenario, but in general they may be able to deduct the recognized loss somehow, but the detailed way of how to do it is beyond the scope of this semester, so I'm not going to go deeper into that, But in general, the loss on disposing of business properties generally can be deductible, right? What about the case of casualty loss? Meaning when the asset is stolen, damaged, or completely destroyed by someone or by natural disaster. Right? So for those cases, so let's say for the first case, right, for the case of the asset is completely destroyed, right? So the deductible amount of loss is going to be equals to the amount of insurance proceeds minus the adjusted basis of the assets, right? So basically, whatever not covered by the insurance, right? Then the taxpayer can deduct that amount, so let's say if the insurance pay only, let's say the basis of the asset is pay $10,000, and then somehow the insurance will pay $5,000, then the leftover $5,000 that the insurance didn't cover, the taxpayer can use that amount to deduct, right? And so that's for the case when the asset is completely destroyed, right? Or for the case when the asset is damaged, but not completely destroyed, then the deductible amount of loss is going to be equal to the amount of insurance proceeds, subtract the lesser amount of the assets adjusted tax basis, or the decline in the value of the asset due to the casualty, right? So whatever lower amount, you can use that amount to subtract with the proceeds, right? And then the idea behind this is still, right, whatever is not covered by the insurance can be deductible, right? So so I think we should stop. It's a good place to stop the lectures here. So I'm gonna make another video cover the rest of the lectures of the chapter 9. So all right, so I'll see you in the next video.